Welcome to the Cardinal Commentary for the Canadian equity portfolios. After a couple of years of seemingly endless stories about rising interest rates and inflation, the headlines are changing. Inflation was 3.9% in Canada last year, down from a 40-year high of 6.8% in 2022. And the question on interest rates has become when, not if, central banks will start making cuts. We predict the Bank of Canada will start cutting rates as early as the spring, and that's good news for investors. Over the last 6 rate-cutting cycles since 1980, the ensuing 2-year periods have seen annual returns of 13%. We are further buoyed by the fact that value stocks, such as banks, healthcare companies, and utilities, have been growing their earnings and dividends, but without a corresponding appreciation in their share prices. Chief Investment Officer Evan Manser believes this combination has created a spring-coiled effect.
Value, I think, is long overdue for beating growth. It's been over 10 years that almost every year in the past 10 years, maybe 8 out of 10, 9 out of 10 years, growth has been ahead of value, and we all know the stocks that have been responsible for a big portion of that. If you go back over long term, 50 years, 70 years, value's still done better. And we think that because there is such a disconnect, I think right now, the only time where growth stocks were valued this high relative to where value stocks are valued is back in the tech bubble. And that was a fantastic period for value stocks. After that, it's always hard to say how far things will go, but we think we got to be close for a 3-year or a 5-year cycle where value stocks are the place to be.
It's important to remember that there are still 2 major wars going on, neither of which appears to have an end in sight, and a recession in Canada, albeit a mild one, is still entirely possible. At the same time, don't lose sight of the fact that stock markets go up an average of 3 out of every 4 years. But no matter what's going on in Canada or around the world, we continue to invest in companies that perform in all conditions. Brookfield Corp is a quintessential Cardinal company, as virtually every one of its many divisions has a must-have good or service, including railways, ports, renewable energy, manufacturing, infrastructure, real estate, and insurance. Evan Manser says Cardinal jumped at the chance when its share price fell because the parent company was a better value than all of these subsidiaries combined.
And so we saw that as an opportunity to buy in. At the point we bought in, the component parts of Brookfield, all the companies that it owns, were actually trading for more than Brookfield, the parent. So it was sort of if you've got 5 different companies and they all trade for $1, that's $5. Well, you can buy Brookfield, which owns them all, for $4. And so we thought it was a pretty good bargain.
And we believe there's plenty of upside to Brookfield, as its intrinsic value, that is what it's actually worth, is significantly higher than its share price. 11 of our companies increased their dividends in the fourth quarter, led by TD Bank at 6.3%, followed by Suncor, Sun Life Financial, National Bank, TELUS, CIBC, Granite REIT, Enbridge, BMO, Royal Bank, and Canadian Tire. In fact, 6 of our companies increased their dividends twice in 2023: Sun Life, TELUS, National Bank, CIBC, Royal Bank, and BMO. There's no question that 2023 was a challenging year in the markets, but our Canadian portfolios continue to outperform when it really matters, like over 15 and 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian equity portfolios in 1993, it would be worth nearly $10 million today, nearly doubling the benchmark. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.